Hello students. So in the previous class we understood what is capital market, what are the types of market, starting with organized and unorganized market, and then we went on to understand types of markets, that is capital market and money market, and then types of capital markets which we saw. Under them primary market and secondary market, and we also understood the importance of capital market. So in today's class we are going to learn about money market. So money market is the market where they deal the financial assets with the very less maturity period. Now maturity period will be from 0 to 1 year. Okay, up to 1 year, any sort of maturity period that is there for the financial asset, that will be traded or that will be considered under money market. So it's completely short term market where if any company requires money for a shorter period of time or for the shorter term, they can approach to money market to get the funds for a short period of time. So this money market will help to keep the liquid position of the company whenever required. So the money market is being divided into four types. The first one is call money market, then we have commercial bills, then treasury bills and short term loan market. Now in call money market, in this market it is extremely short period where the loans are available for the companies or for people from 1 day to 14 days. So if you want a loan, you will have to go to call money market. Especially the companies would be for the companies it would be very beneficial if they get this loan for a shorter period of time, which will help them to comply with their working capital requirements on day-to-day basis. So this call money market is very liquid. It's highly liquid market where these loans are repayable on demand. Okay, either one of them, that is the person who has given the loan or taken the loan, will demand for the repayment. So that is the call money market. Now there are major markets, money markets, which are present in the stock exchanges, especially in the major industrial cities like Mumbai, Kolkata, Chennai, even in Bangalore you have one. So these markets will help the company to abide by, and it will help the company to run smoothly with the day-to-day money transactions, whatever is required. The special feature or the special quality of this market is that interest will vary from day to day. Sometimes interest will even change from 1 hour to another hour, from one place to another place. So wherever there is demand for the loan and wherever there is supply of the money, there the call money market will be present. So this is call money market where the loans are available for a very short period of time from 1 day to 14 days. The next type of market is commercial bills market. Now in this market, the bills of exchange which is coming out of the trade, whenever they do business, there will be credit sales and there will be credit purchases. Excuse me. Now in this case, whenever there is a credit sale, now they can draw a bill of exchange instead of paying it immediately. If we are paying the money after 2 months, 3 months, okay, that uh, time period, for that time period I will write a bill of exchange, and that bill of exchange will be dealt in the commercial bills market. Okay, so the buyer will accept such bill promising to pay on the later date. Now I have already I have already explained about factorization of the bills, and once more to repeat that. Now what happens is, when there is a commercial market, when there is a commercial bill market, in this scenario, what that is going to happen is that, let me show you with an example. Now there is a person A and there is, let's say there is a company A and there is a company B. Now company A is a supplier for company B. Okay, supplier. Now let's take for example, B is Big Bazaar. Okay, B is Big Bazaar. A is Hindustan Unilever Company, or now it is called as Unilever Company. Okay, now Hindustan Unilever Company will give the products, will supply the products to Big Bazaar, wherein they can sell the products. It's a market, right? It's a supermarket where they can sell the products. Now for the products that has been given to Big Bazaar, B has to give the money, right? Now B does not have money and B will say, I will draw a promissory note or I will draw a bill of exchange where you can collect the money after 3 months. Okay. Now in January 2021, this transaction has happened and the payment will be done in March 2021. So there is 3 months that has been completely taken to pay the amount. Right? Now A will accept the bill. A will accept the bill and A will be okay with the bill that has been given to it. So there is no problem with that. Now what will happen? A is in need of money. A has this bill of exchange, but A requires money immediately. A requires money immediately. So what will A do? A can take this bill of exchange to the bank, or it can take it to this commercial bill market. Okay, commercial bill market. There are few institutions who will do full-time job of discounting. So when they take it to the bank, okay, so the bank or this commercial bill market will discount the bill. Suppose if the bill was for 10,000 rupees, now the bank will pay back, let's say 9,500 rupees. 500 rupees will be the charges for discounting. That's an example. They will have some percentages. So 500 is the charges for the bank. Remaining 9,500 will be immediately given to A. So this is called as discounting, discounting of a bill. And this discounting of the bill can be conducted or can be taken place in the commercial bill market. So here the companies will get their commercial bills, that is their business bills, and they will get the money immediately by discounting them. Okay, by discounting them they'll get the money. Now in March, when Big Bazaar pays the money to a company, when Big Bazaar pays the money to a company, they will be paying it back to the bank or the commercial bill market from where they have got the money. Okay, from wherever they have got the money, they are going to get that money back. So this is the main transactions that happen at commercial bill market. I hope this is clear. Now here, before there were no specialized agencies, but now slowly there are many companies or agencies which have come up with these discounting. So those are at a higher level known as factorization. So they will take all of those debtors from the company. They will take all of these bills or negotiable instruments from the company, and they will make sure that they will collect the money and give to the company. So collection of money for the company itself has become a separate field, But here in commercial bills market, they are going to get the bills of exchange which is coming out of genuine trade, which will be used here and where they will do the discounting. Okay, so that is commercial bills market. Now moving further to the next type of market under money market is treasury bills market. Now again, treasury bills, popularly known as T-bills, this is given by RBI for the short term. The maturity of these bills are for the short term. Now in the short term, what happens is the treasury bill is like a promissory note. So they will promise to pay certain amount after a period of time. And these are highly liquid. Highly liquid means if you give that treasury bills, immediately they'll give you money. Okay, so the cash will be there already present. So this treasury bill market is issued by the government for a very short period of time, and it is highly liquid because its repayment is guaranteed by the government. Since government themselves are saying that they'll pay back the money, so it is very easy for people to trust and get back the money from the government. There are two types of treasury bills. One is regular treasury bills or ordinary treasury bills. The other one is ad hoc treasury bills, popularly known as ad hocs. So in the ordinary treasury bills, they are issued to the normal public, they are issued to the bank and financial institutions. Whenever central government wants money, okay, whenever central government wants money, they will issue the treasury bills. So people have to give money and take the treasury bills. So here government is promising that they are going to give back the money after a certain period of time. It's like you are giving loan to the government, you are giving money to the government to use it. Okay. Now few of the times what will happen in the economy, the money will be too much. There will be a circulation of too much money. Now we have understood how the financial system works. We have understood what is important to be learnt in the financial system, and we know how the cash flows in the financial system from people to banks to companies, from stock market to companies, and then companies to stock market. So there is a lot of interconnection. It's a network, right? So since we have understood all this, now here central government or RBI also wants some money for their usage. So they will be issuing these treasury bills and they will be buying the, or they'll be taking the money from the public, banks and other financial institutions. The major trust here is, since it is issued by RBI or the central government, there is more of trust they will give back the money for sure. So ordinary treasury bills or T-bills are given they are issued by central government and they are issued to public, banks and other financial institutions, and it is for short term. Then ad hoc treasury bills, that is the second type. Now this is issued in the favor of RBI only. Now whenever RBI requires money, they will issue such ad hoc treasury bills, and they are not sold through a tender, so they can be purchased by RBI. So government will issue ad hoc treasury bills and RBI will buy that. So it is a transaction between the government and RBI. Because RBI is another separate body which is working under RBI Act. So they will have their short-term financial needs which has to be taken care of. Now ordinary treasury bills which is given by central government will be given through website or will be put on an auction or tender where people can buy. But ad hoc treasury bill is only given to RBI. Okay, so these ad hoc treasury bills normal public cannot buy, because who can only buy this? Only RBI can buy this. Okay, then treasury bills have a maturity period of 91 days, 182 days or 364 days. So these are the three varieties. 91 days, somewhere around 3 months, close to 3 months, 182 days, 6 months and 364 days is 1 year. Okay, so these are the three variety of treasury bills or T-bills that can be available. And then financial intermediaries will be there for all of these bills where they will also be earning certain percentage. So we have understood three types of instruments or three types of money market. So that was treasury bills market, commercial bill market and call money market. Now coming to the last type, that is short term loan market. Now in short term loan market, as the name says, it is given for a short period of time. Especially commercial banks plays a significant role here because they will have to arrange for the liquid cash when companies require for the working capital. We have partnerships, we have sole trading concerns, we have LLP in the economy, we have 1% company, we have public company, private company, and again you can come up with lot of other varieties of company, different nature of business. So when we have so much variety of company in the country, every company requires different types of capital, different working capital requirements. Working capital is nothing but every day how much money is required to run the show or to run the business. Okay, they would require money to do some postage. They would require money to do some banking transaction, transportation, right? Paying for the daily wage workers, if there are there, usually manufacturing companies will have them. So like this, they'll have many other stuff along with that, some refreshments, tea, coffee stuff, lunch if it is supposed to be paid. So for one day, how much a company is gonna spend, that will be calculated and that is called as working capital. Okay, so working capital, yesterday I also explained about overdraft. Now overdraft will be given to the business people on their current accounts, right? Apart from that, if they want extra money, they can take working capital and that working capital can be availed in this short term loan market. Now this short term loan market, they will be able to give money for a period less than 1 year and the interest will be charged separately on this where they can give back the or pay back the money. So this is money market. Both capital market as well as money market plays a major role, especially when it comes to business transactions. When it comes to company, how do they maintain the daily activities? How do they maintain yearly activities? Everything has to be with the help of these two major markets, that is money market and capital market. Okay, I hope it is clear about the money market and capital market. Next, a little introduction about the foreign exchange market. Okay, so foreign exchange is part of every country because we will be doing transactions, we will be doing lot of import and export from one country to another country, right? So in these cases, we would require to exchange our currency also. So that would be foreign exchange market. Now, if we are importing food grains or if we are importing electronic items, and if we are exporting, if we are sending our cotton clothes, if we are sending our spices, if we are sending our machinery to other countries, now they have to pay us, right? We are sending clothes, they will pay us the money. If we are getting the food grains, we have to pay them the money. Okay, so the currencies are different between the countries. Now in such scenario, what will happen? We are expected to make sure that the currency from one to another is being exchanged. So foreign exchange is a system or process of converting one currency into another currency or transferring money from one country to another country. Now we have rupees, okay, they have dollars, there is Australian dollars, there's euro, yen, won, there are so many currencies, and even in rupees, Indian rupees has different value, Pakistan rupees has different value, Bangladesh rupees has different value, Sri Lankan rupees has different value. So like this, since the value differs of the currencies, so this again have an opportunity of becoming a market. So that is foreign exchange market. In India, this foreign exchange market is been regulated or taken care by Foreign Exchange Management Act or Maintenance Act known as FEMA. So FEMA plays a major role in understanding the rules, how to do the foreign exchange transactions, what are the rules of getting the product, selling the product, from where we can these foreign exchange people can get the loan, how they will be helped, but then everything will be taken care by RBI as the central place. Okay. Apart from that, in the country there is also Exim banks, EXIM. Now what are these Exim banks? Now Exim banks are export import, okay, export import banks. Export, IM is import, export import banks. Now these banks take special care with the foreign exchange market. They are closely linked with the foreign exchange market. Every time there is a exchange that happens, RBI has to be informed about it. So this is the brief introduction about the foreign exchange market, which is enough for you. Okay, I hope it is clear to everyone until here. Now moving further, we have to understand few differences between. Now difference between primary market and secondary market. So we understood what is a primary market, we understood what is a secondary market. So here let us understand what is a primary market and a secondary market. Okay, so primary market is for the financial instruments when it is first time given to the public. When a company issues shares for the first time to the public, that will be dealt in the primary market. Now when it comes to secondary market, after first time, if we want to sell it again, now let's say for example that there is a company, and that company, there is a company called XYZ, and this company is issuing shares for the first time. So they will be selling their shares in the primary market. Okay. Now I have bought the share. I have bought the share of this XYZ Limited. Okay. Let's say I have bought 10 shares. Now I require money. Okay. Now I will be selling this shares. But where do I sell? Selling is okay, but where do I sell? I should sell this in the secondary market. When I buy from primary market because they are selling for the first time. When I sell, I can sell from the secondary market. Okay. Now, if I sell, somebody has to buy. Right? If I am selling, somebody has to buy it. Only then I can sell. So, in the secondary market, you will see buyers as well as sellers who will be selling and buying the shares for the second time and after that. In primary market, only for the first time they will take, and then if they want to sell and buy and do anything later, will be taken care in the secondary market. That is the first major difference. Okay. The next is the main purpose of primary market is to provide finances to organization so they can do whatever job that they had planned for. Usually whenever the company requires money, they will issue shares and collect the money. Okay. But that activity, if it is done for the first time, when they issue shares for the first time to the public, and when they collect money, that is under primary market. And why do they collect money? To utilize that money in the business. They would be starting a new project, they would want to buy a new building for the company, they would want to set up a complete new business under the company. Okay, so in this case they will find a chance where they can uh, get the money from the investors through shares, debentures and many other instruments. So that will be done in the primary market. Now secondary market, they are just like trading. They don't give money to the business directly. Okay, like primary market, they don't give money directly to the company here, but they just keep trading. It will just keep changing hands from one person to another. Now in this example which we saw here, now first when I bought the share, I paid the money directly to the company. Okay, now when I sell the share, it is just changing hands. It is going from me to another person. So in a secondary market, we don't pay money to the public. It will just be changing hands from one person to another. Whoever requires the shares, whoever wants the money, only they will be buying and selling, and that small difference in price whatever you see, that will be the profit or loss for the people. So that is in the secondary market. That little price. Now let's say for example, I had bought each share at 100 rupees. I had 10 shares, I had bought each share at 100 rupees. Now I am selling each share at 105 rupees. Now 100 minus 105, I am getting 5 rupees extra for each share. Correct? So that 5 rupees extra for each share, that is the margin, or that is the small amount which I will get extra. Okay, so that is the secondary market difference. Then the primary market involves direct contact between the company and the investor. The company here in the primary market, what will happen? When I bought shares from XYZ company, I directly had a contact with the company. Okay, I went out there and I told, yes, I am interested to buy your shares. Please give me your shares and take the money. So I am directly in contact. Okay, I will go and have a conversation or attend the meeting of the company. So the company offers shares to the investors who are interested in buying them, no matter how much is the money. That is primary market. Now in secondary market, though people are there, though the shares keep changing hands, you will not be directly involved always. Okay, you will not be directly involved always. You will get the information from the company. You will get the information from the company, what they are doing, what are their decisions, all that information you will get. But like primary market, for the first time when you buy, you are in contact with the company directly. But secondary market, you will only get the information after everything is done. So that is secondary market. Then the primary market, the price of the financial instruments are fixed. Okay, so the company, once it issues the share, it will say, yes, we are issuing shares at so much amount, so you can come and buy at so much amount. But in the secondary market, because of demand and supply of the market, because of demand of the shares of particular company, the price will keep fluctuating. The secondary market whole and soul depends on many factors, but then the major factor that it mostly depends is demand and supply. What is the demand for the company on that particular day, how it is working, what is the news from the company, all that will be considered, and based on that they will be doing the work. So that is for the first part. Okay, so secondary market participants will not know every information directly, but they'll get the information later. And mostly all the prices are fluctuating, and the fluctuating prices depends on the demand and supply aspects. Then primary trade of financial instruments is usually not rooted in specific place. So they now, since we have global concepts, globalization concepts. So when they want to sell the shares, they'll do it online. Everything is computerized. So before they used to sell only in the registered office, they have to go to particular place and get, it was all there. Now it is online, so it is easy to get things done. So that is in the primary. And I mean for the first time when they sell. Now when it comes to secondary market, there are stock exchanges. Now again, stock exchanges are in the form of dematerialized. So if you have a demat account, you will be, as an individual, you can take care of both primary and secondary market. If you want to buy for first time, you can buy it when the company is issuing shares, or if you want to trade it later, you can do it through the same demat account. So after computerization, after getting everything into digital format, now it is more easier for people to trade or for people to buy shares from the companies. Okay, so from the view of company only, this bifurcation of primary and secondary market is there, because these are two separate platforms where they will be able to issue shares in primary and then later control the demand and supply in the secondary. So that is our difference. Then in primary market, underwriters will be there who will help in selling the shares. We will have certain intermediaries. We will attract investors to come and buy the shares from us. But in secondary market, there will only be brokers who will be there to get some profit margin. Okay, now brokers will be working for their own profits. Okay, they will not, for them what is important is their profit. So to get that profit, they will have to help others to buy and sell the shares. So that will be the work of the brokers in the secondary market. But when it comes to primary market, underwriters are the intermediaries. They are the people who will be able to give the investors the shares that is required, extra information that is required. So here there will be other professionals involved. And then in primary market, if the financial instrument is sold only once, since it is for the first time, it will be sold only one time, and whoever wants to buy, they'll be called as the owner of that instrument. Okay, now owner of the instrument means if I am buying a equity share, I will be called the owner of that equity share. So I have all the rights on it until I sell it to somebody else. Okay, so in primary market, they will sell the share only once, and if I buy, I am the owner. If you buy, you are the owner. Okay, that ownership and the name of that will be written clearly. But when it comes to secondary market, you can buy and sell for a number of times. Any share, any number of shares, any number of times you can buy and sell. Because here you will have sellers and buyers who will require shares, who wants to buy shares, who wants to sell shares. So you can have that transaction directly. So these are the differences between the primary market and the secondary market. Okay. Now another set of differences that we are supposed to learn is between capital market and money market. Now money market and capital market, we have just understood about the money market, where the market is only for the short term loan which is not exceeding 1 year. But when you consider capital market, it is for the long term funds which goes beyond 1 year. Correct? So
money market is, always remember, money market. Money is liquid. So money market is for the short term. Capital market is, capital means too much money. So it's for the long term. Now in money market, the whatever the financing is being done, it is for day to day basis or for the shorter period of time basis. Like working capital, working capital is day to day, and short term loans that is required. Maybe they have to pay somebody, so they would require the money. It can also consider the requirements of the government. If government wants money, then also they can raise the money in the money market. Now we understood, using treasury bills, the government can get money from the people, right? So that is money market. Now coming to capital market, here it is for the fixed period of time, for a long period of time. We will deposit, or we will raise money, or we will invest money. Let us say, for example, we are investing, let's say I'm investing 10 lakh rupees into the capital market. Let's say I have bought equity shares worth 10 lakh rupees. Now this equity shares of 10 lakh rupees I will keep with me for another 15 years. So that is a capital market instrument. I am buying it for a more price. I mean, more investment is done from me, and I am keeping it for a longer period of time. Okay. Now my money of 10 lakhs which is put into the company can use that for a longer period of time, because for next 15 years I will not ask my money. Right. So that is capital market. Then the instruments are dealt in money market. Now what are the instruments? We understood treasury bills, commercial papers, certificate of deposits. This is also a negotiable instrument. Okay. So commercial papers, we understood that you can have commercial paper like bill of exchange. And then when it comes to capital market, it will be shares, debentures, government bonds, and many other instruments which we can see, stock, then warranties. You can use all of that. And in money market instrument, each money market instrument will be of a larger amount. Now if you want to buy a treasury bills, for example, it will be minimum 1 lakh. So investment into these short term will be of a bigger amount. Okay. But if you take a capital market instrument, each unit will be less amount, but you can invest more into it. So one share will be costing you 100 rupees, 2000 rupees, 1500 rupees. It is not that you have to invest 1 lakh only. You can invest 10,000, 20,000, 50,000. It depends on the person. Okay. So that is the next difference. In money market, more lump sum money has to be put into the money market, but in capital market you can put the money in units or bits and pieces. Then the money market, central bank and commercial bank are the major people. That is RBI and all your other banks are the major people who will take care of the money market. But when it comes to capital market, it will be your companies, development banks and other insurance companies who will collect the money and give it to others so that they can utilize it. Okay, so that will be the capital market. Then money market instruments generally do not have secondary market, which means we just understood the primary and secondary market. These treasury bills, certificate of deposits or commercial paper, you cannot sell it to others. You can invest the money, you can take back your money. Okay, you will usually you will not have the other people who will buy it from you. Usually, it's not said it will not have at all, but then usually or generally you will not have. But then when it comes to capital market, we already know shares, debentures, everything is sold in the secondary market. that is the stock exchange. So you can sell the products in the stock exchange. So money market, there is no formal place. It happens in phone. You can call your bank managers. You can call. You'll have people who will help you in getting these money market instruments. But when you take capital market, there is a particular place called a stock exchange. Now this stock exchange is online. You have stock exchange, you have Bangalore Stock Exchange, Bombay Stock Exchange, okay, National Stock Exchange. So you have stock exchange, but now it is done online. So it is easy for people to buy and sell the shares online. Then transactions have to be conducted without the help of brokers. In money market, it is direct dealing between you and the government, you and the company, and you and the money market, or the company and the money market. But when it comes to secondary market, you will have certain authorized people who are called as authorized dealers, authorized brokers. So you will have somebody to help you out there in buying and selling the shares. So this is the difference between money market and capital market. Once again, money market is for the short term, for not exceeding 1 year, and capital market is for whatever long term investment that you want to do for more than 1 year. Okay, so we have understood financial system, how financial system works, components, types of markets, financial markets, types of markets. In that, what are the types, like financial assets, intermediaries, instruments, okay, and then difference between. So this completes our chapter 5, financial markets, and also this completes our syllabus of the subject BOMD. Okay, yeah, thank you students.